All right, let's get toward our interview. Let's bring on Adam Johnson. How are we doing today? Welcome back.
Hey, great to be with you, Mitch. Merry
It's good.
Christmas, Happy New Year, all that good stuff. We're back to
Yeah,
work.
definitely. It's good to be back, just getting ready for the new year. And I think one of the most important thing is kind of looking back and learning what we can really
Yeah,
take a step forward, right? Because if we're not taking a step forward in our career, our skills, or maybe our portfolio, well, then I don't think we're really meeting our goals, right? And we all are shooting towards meeting those goals. So let's get into it first. I know that we've already done an interview looking into 23. That was a little bit back in October in the fall time. So let's talk a little bit about what has changed, really. Of course, we have been seeing inflation truly start coming down, and
oh yeah.
Jerome Powell start finally slowing down the pace of the interest rates. What does that mean for 23?
I'm amazed actually, Mitch, and I'm glad you're starting with Jerome Powell. I'm amazed
Yeah.
that people still think that he's the most hawkish central banker in the world. He's not.
Yeah.
He's already told us that he's effectively, in fact, the whole Fed, based upon that dot plot, the whole Fed structure, all the governors have basically told us that they're pretty close to done. They're going to raise rates another maybe 75 basis points, and then they're going to pause because, as Mr. Powell told us, it takes time for rate hikes to percolate through the economy, right? And he wants to see, how we doing? So it's amazing to me that we're all still saying, yeah, gosh, he keeps hiking. No, he's almost done. That's the pivot. He's not going to lower rates anytime soon, but I think he is going to stop raising rates in the first quarter. And at least if rates aren't going up anymore, Mitch, what we can do as analysts is now say, all right, here's where interest rates are going to be for the foreseeable future. Let's rerun our dividend discount models. Let's rerun our cash flow analysis because we know where rates have stopped, right? So that gives us some certainty. We might wish that rates were lower, but at least we know where they are. And I think that certainty will enable people to have some confidence and go out and start buying stocks again.
Let's talk about that, Adam, because I feel like it makes extreme sense, especially when you're talking at the institutional and the hedge fund level, right?
Yeah.
Because at the end of the day, to put the inputs into their models, they either had to estimate where the end was going to be, but now we kind of know where the end could be, right? And that's the important thing. I think that, early in 2022, you just had to guesstimate the ending outlook. Now, like you said, there is the ending outlook. So those models will come back more into play. And that could probably be bringing some more money back into the table, back on the sidelines, right? I mean, that's just normal right there. And using some statistics to finally come into play. Cash flow has been an extreme focus in 2022. I expect it to be an extreme focus into 2023 as valuations start to matter again, right? For a little while there, I don't know what we ran into, but it was something else, something fierce.
Oh, yeah, it sure was. You mentioned cash flow, and that's really the whole story. When interest rates are low, you can get away with a lot. As Warren Buffett likes to say, it's not until the tide goes out that you find out who's swimming without a swimsuit. And once interest rates start to go up, companies that were probably borrowing money they shouldn't have been borrowing, all of a sudden, their backs are against the wall. And that's where the short sellers zero in and say, this is unacceptable. It's a weak company. They don't have the cash flow to support the debt payments, or, hey, wake up, this valuation's too high. Shouldn't be trading at 20 times sales, et cetera. So there's been this huge flushing out that has turned into a flush of everything. I think we're actually starting to get towards the end of that. Just here, got my notebook right here. Just before you and I jumped on, I ran a screen. Super simple screen for my Bullseye subscribers. And I said, show me all the stocks in the S&P 1500. So large cap, mid cap, small cap. Show me all the S&P 1500 stocks where there are at least 5 analysts, where the Bloomberg analyst rating is at least 4.5 out of 5, which means basically it's almost all buys and there are no sells. And then show me finally where the average price target for these analysts is at least 50% above the current stock price. All right. In other words, I'm looking for quality names that are trading at a big discount to the target.
Yeah.
Here's some of the names that showed up, which just gets to this notion that everything's been flushed. Amazon. Okay, I know people think, yeah, Amazon should be down, but Amazon made the list. Delta, Salesforce.com, Signature Bank of New York, extremely well capitalized. EQT, one of the best operators in the shale patch. Coherent Lasers, COHR. I mean, these are very high quality companies, and as you point out, all with very strong cash flow that have been flushed. We are at a moment where everything is getting flushed. Now, there are a bunch of names on here that I'm sure our viewers and listeners have probably never heard of, and that's fine. But I wanted to at least share with you some of the obvious ones, because it really gets to this notion that when people are in sell mode, and we have been in sell mode for quite a while now, they just sell everything. They just go to cash. They get totally disheartened, and I don't think that's a smart way to invest money over the long haul. You might save yourself from grief for a couple of months or a couple of weeks, but this is where we buy, Mitch. Down here, it's uncomfortable, it's hard to do, but this is where we buy.
Yeah, it's really difficult. And I feel like, you've talked about it in our video last time, that some of the big boys and the hedge funds, right, that might have some positions in like an Amazon or let's say a Microsoft or Google that's down big, right? Like, we all know they have exposure to these big names, right?
Sure.
So what are their mentality as they go into 2023, right? What is that mentality? Will they be moving even more money into those best of breed stocks? And it's going to be more of that stock picking environment.
I think so. Well, just take the guys who are a couple blocks from me here in New York City in Midtown over at Tiger Global, right? Julian Robertson's firm. And there are a number of managers over there considered for a long time the smartest guys in the room. They're growth managers. Like me, I'm a growth manager. I'm not really a value guy. American ingenuity, the people and companies driving the world forward, right? But a lot of these managers over at Tiger Global are down 50%, along with Kathy Wood over at the ARK ETF, or Bailey Gifford out of Scotland, but they buy a lot of US companies. Growth managers are down big time double digits. And so if you're one of those guys, if you're a Chase Coleman, to name one of the better known Tiger Cubs, not that he's a Cub, they were running 18 or $19 billion. Now they're running 8 or 9 because it got cut in half. If you're going to try to make that money back, you can't go to little biotech companies that no one's ever heard of. It might be a 10 bagger, you might buy a $2 stock and it ultimately goes to 20, but because they're so small and illiquid and you run $8 billion, you can't get your position on. So you go where you can get a position. And I think that's these large cap tech names. Take your pick. I shared a few with you, but they're all down. From Salesforce to Palo Alto to Facebook to Google. Apple today, the lowest since 2021, on and on. If you're a Chase Coleman over at Tiger Global, you've got 8 billion and you need to try to make back 8 billion. You're going to go buy a big chunky stock with cash flow, but a big chunky stock where you can get your position on, that everybody knows that when this market turns, we'll find a bid. And so I think that's a reasonable place to start your search if you're looking for names to buy.
And of course, let's talk a little bit about 23, and where do you expect to see maybe more pain, or where do you think that you could see maybe a trend rapidly reverse?
Well, look, oil has done incredibly well. And, what if? Let's just play what if, crystal ball stuff, right? What if for 2023, there's some sort of, to use a fancy word, rapprochement. We'll use the regular word, peace, between Ukraine and Russia. What if hostilities, I don't want to say cease, but they find some sort of common ground and they start to negotiate. The first thing that's going to happen is oil is going to drop 20 or 25 bucks. Well, guess what's going to happen to all these oil names that have led the rally, from Chevron and Exxon to an EQT or to an EOG, et cetera. All these companies that were left for dead 2 years ago when oil went down to negative $35 and have come roaring back. They're going to get hit hard. So I actually think oil is a place where there could be some risk. Also, you're starting to see supply come on now from both Iran and Venezuela, and that's starting to make up for the lost production from Russia. But again, if you've got some sort of rapprochement between Ukraine and Russia, then that Russian crude comes on, plus the Iranian and Venezuelan crude. So I think there's actually some risk in oil. I really do. I don't own any oils right now, and I'm a former oil trader. I love oil. I could talk about it all day, but I don't own any oils right now, Mitch.
Yeah, it's tough because you're near the top end and you've been running for a very long time. Let's just be honest. And you're right. If for some reason we were to get a massive supply back onto the markets, what would that do? And if we're already talking about recession, what would that do? Right.
Right.
Well, I mean, if those are the things that we're looking at into oil, it's starting to seem like we're having more headwinds in oil than tailwinds. So
Agreed.
Just something to think about.
Yep.
All right, let's keep going. Let's take a look at what are your thoughts on global recession, right? I know that we're not here.
No.
I like that. Well, why no? Why no?
And by the way, I'm not going to speak to global, but I will speak to the U.S. I'm an American ingenuity guy, and the U.S. is the largest economy. So if the U.S. avoids recession, that bodes well for the rest of the world.
Yeah.
But I'll tell you why, Mitch. We have the most number of people ever making the most amount employed. Okay, the most number of people ever are employed. Fine. As a result, they are making the most amount of money ever. Collectively, they are out there spending the most amount of money ever, and that has been generating what has been the highest earnings for the S&P 500 ever. Now, I will admit that earnings may face some headwinds over the next quarter or two, but my point is, when you've got record numbers of people working, generating income, spending money, it's awfully hard to see how that becomes a recession over the next couple of quarters. I just don't see it, Mitch. I think that we have worked ourselves up into a froth about recession. And one of the reasons I think we have done that is that COVID really damaged our collective psyche. We kept getting hit with one variant after another. And so we kept kind of looking over our shoulders. Wait, what's coming next? Well, I think we're applying that same mentality to the market. Inflation, oh my gosh, that's bad. What's coming next? Well, could be recession. What's coming next? Maybe earnings are too high. You see what I mean? It's almost, it's as though we're in this negative cycle where we're looking for reasons to sell. If GDP is too strong, we say, see, the Fed's going to have to really clamp down on rates. Yeah. If GDP is too weak, we say, you see, the Fed's already caused recession. We're looking for reasons to sell. It's a negative mindset. We need to get out of that, and we will. But I think that the economy is fundamentally too strong to go into recession the next couple of months. I think we already had it in the first 2 quarters of this year when GDP actually contracted. It's expanding now, Mitch.
Yeah, and I think that one of the things that I feel like most people, and it was a different time, right? We always try to relate it to another time. It was a different time this time, and I feel like a lot of the consumer had built up enough savings that. Yes, inflation's did hit, right? That, I mean, we all can see that, right? We all were paying more for goods, but the consumer made it through. And if anything, it's shown how strong this economy is. At least I would say.
Thank you. Agreed. Yes. Yeah.
All right. Let's get into maybe some tech names, right? And some of the biggest ones, right? And we can talk a little bit about them, right? Like we could start with maybe like a PanW that has been getting hit lately, but of course, I don't think anybody thinks cybersecurity is going away anytime soon. And this is a best of breed. Where would this make sense? Because
recently named number one for cybersecurity by Gartner, and you call it what, PanW, otherwise because that's a ticker, PANW, otherwise known as Palo Alto Networks. Recently made a look at that. There's the chart, and what is that? A 5-year chart that we're looking at, Mitch?
It's the weekly that goes back to like 2019. So you could say 3 or 4 years. Yeah, 5 years.
Yeah, so you can see. I mean, it's certainly at a 12-month low. I like it in here. You look at valuation, and all these names are kind of trading in the same spot. And by all these names, I'm talking Salesforce, Google. Palo Alto Networks, Apple, etc. They're all kind of trading in the same spot, somewhere between 20 and NVIDIA, 20 and 40 times earnings, with growth of 20 to 25%. And it's consistent growth, plenty of cash flow, low debt. These are names you want to own. And as you said, cybersecurity has only become more of an issue. In fact, if you look at some of the Gartner surveys of C-suite executives, chief technology officers, chief financial officers, the people who are writing the checks, 80% of them in the S&P 500, 80% of C-suite executives expect to spend more on cybersecurity in 2023 than they did in 2022. That creates an enormous tailwind for a company like Palo Alto, which is, again, the largest, and it's the best in breed.
Love it. Those are companies that I also feel could be, like you mentioned, a little bit recession resilient. Even if we were to get in trouble, well, I still need to kind of pay the cybersecurity bill, right? I mean, that's just the way it is. And especially in an environment where we're getting further and further into controlling of data, right? Really being ownership of the data. Cybersecurity is going to be playing top part in that. Now, of course, there is a company that has been getting, the backfire, and I'm sure you've been seeing it all around, Elon and Tesla. What do you think about this story? I had to get towards it. What do you think, Adam, here, as Tesla has been retracing a pretty substantial amount in December?
Yes, it has. I've never owned it. I don't own it now, and I don't intend to buy it.
Okay, tell us why.
Review. Yeah. And what's interesting is that you're probably the fourth person to ask me. I was on Fox Business this morning, and they asked me about it. And two of my subscribers, my bullseyebrief.com subscribers, have asked me about it literally in like the past 48 hours. Because everyone's kind of looking at that chart and saying, hang on, I know it's a falling knife, but it's Tesla.
Yeah.
Yes, it's Tesla. But the problem is it doesn't have a CEO right now. I love Elon Musk, but he's not focused on Tesla. He's focused on Twitter. So he's absent right now. And you add to that the fact that, this thing is trading at, I don't know, what's the multiple? You tell me, you've got it up there in front of you.
Maybe like
probably
60s or 70s, but I mean, I'll take a look there.
Yeah, a PE of 60, and GM trades at a PE of what, 7? Ford, maybe 6. Why should I pay 60 times for Tesla when I can go buy, GM for, 1/10 of that valuation? And by the way, GM pays a dividend. You could make the argument that Tesla is actually a battery company disguised as an auto company, and that might be a reason to pay a higher multiple. But I just can't get comfortable with Tesla right now as an auto company that has yet to really delineate a battery strategy, and as a company that is missing its CEO. So I'm sorry, I just can't go. I'd love to, because it fits my American ingenuity, people and companies driving the world forward paradigm. But for reasons specific to Tesla, not doing it.
Yeah, Adam, I've heard you mention it before. We got to look into our leadership there of our companies, right? It matters so much. And there's certain times where I have heard from a CEO and been like, you know what? I want to buy that CEO because I know that he's going to drive this company in the right direction. Yes. And then there's certain times where, like this situation, where it's been more like, well, I don't want to be anywhere near that company because of the CEO.
Right.
It seems like that's slowly but surely becoming Tesla. And that wasn't the case, let's say 2 years ago. Definitely was not the case.
No,
so it just goes to show you that sometimes the story can change, right? And I think we all need to be flexible. We all need to be kind of watching what's going on. Last thoughts for investors going into 23, Adam. What do you have for them?
Well, I think we need to recognize that 2022 is one of those years that does come along from time to time, but it's rare, thankfully. And the world is a lot better than we sort of, I think, collectively believe. And so if anything, I'm going to call 2023, Mitch, it's going to be the Wayne Gretzky year. We need to skate to where the puck is going, not where it is, because where it is and where it's been isn't great, but where it's going is a lot better. I think we need to look forward. I think we need to be positive, and I can give you some very specific data on something that happened last week. It's the message from the options market, Mitch, the put call ratio, which is probably something you look at as well, right?
Yeah.
Puts allow you to protect stock. A put makes money if the stock goes down. By contrast, a call makes money when the stock goes up. Typically, investors buy more calls than puts for the simple reason that over the long haul, stocks tend to be up 2 days for every 3. So you want to be long calls, not puts. Right now, people are buying a lot more puts than calls. In fact, last week, the put call ratio went to 1.5. For context, Mitch, the put call ratio has only gone above 1.4 5 times in 5 years. It's really rare when people get so negative that they're buying 1.5 times as many puts as calls. And if you fast forward over the next several months, what you find out, Mitch, is that on all 5 of those occasions in the past 5 years, when the put call went above 1.5, stocks rallied all 5 times. And they rallied by an average of 31% over an average time period of 7 months. So I think that actually bodes pretty well, and it lines up with my other feeling that we've just gotten way too negative about everything, and that earnings are going to be less bad than feared. And oh my gosh, Mitch, they might actually be okay, which is what happened in the third quarter. I think we're going to see that again in the fourth quarter.
Well, like always, Adam, you're not short of optimism, but I'd call you more realist looking into what's going on out there. There's a lot of pessimism out there right now into the market, inflation, and everyone expecting to be on the negative side. And a lot of what happens, and I'll go to a quote that Dennis Dick has taught me from our pre-market prep show, is that the market likes to hurt where it can hurt the most. And if the most is going to be leaning on that bear side, you called it there with the put call parity. Well, there you guys see it. It looks like the bears might be in control for a short term, but we all know we'd rather be in the markets than out of the markets, because usually we come back up and we come back roaring. I don't think the U.S. is in any trouble here overall. I think we're just going through a little bump in the road, and we'll be back next year. And I'll definitely have you back, Adam. Appreciate you like always. Thank you for coming on all this year. And I truly hope that you have a great New Year's, and blessings to you, my friend.
Oh, you too. Hey, thanks, Mitch. You tell me whenever you want me to come on, and I'll be here.
Always. Have a great one, Adam, and we'll bring you back. Take care.
Thanks, Mitch.